Want to learn the essential life and health insurance topics quickly? This slides guide is packed with high-priority points to help you study smarter, not longer. Now, let's dive into life insurance policies, overview, and structure. Slide 1, Life Insurance, 3 core categories. Life insurance can be divided into 3 main categories: industrial life, group life, and ordinary life. Industrial life policies are usually very small, ranging from $1,000 to $2,000. They are designed to cover basic needs like burial expenses, and premiums are often collected weekly, making it accessible for everyday people. Group life insurance works differently. It provides coverage under one master contract for a group, such as employees in a company or members of a union. Individual underwriting is not required, and evidence of insurability is not needed. This makes group life convenient for organizations that want to provide protection to many people at once. Ordinary life insurance includes term, whole, universal, and variable universal life. These policies are more flexible and offer different guarantees, cash value options, and varying levels of risk, making them suitable for long-term protection and planning. Slide 2, Term life insurance. Term life insurance provides protection for a specified period, such as 10, 20, or 30 years. It does not accumulate cash value, which is why it is the most affordable type of life insurance. If the insured outlives the term, coverage ends and nothing is paid. Level term keeps both the premiums and death benefit constant throughout the period. Decreasing term gradually reduces the death benefit, often used for paying off mortgages or debts. Increasing term gradually increases the benefit, sometimes tied to a cost of living adjustment. Renewable term allows the policy to continue after the initial period without a medical exam, although premiums rise with age. Convertible term lets the policyholder convert to permanent coverage, such as whole life or universal life, without going through underwriting again. Term life is ideal for temporary financial protection, like covering young children or paying off loans. Slide 3, Whole life insurance. Whole life insurance provides lifetime protection with guaranteed cash value and fixed premiums. It combines financial protection with a savings component. Straight or ordinary whole life requires paying level premiums for life. Limited pay whole life allows premiums to be paid over a shorter period, but coverage continues for a lifetime. Single premium whole life requires one lump sum payment to fully fund the policy. Some whole life policies feature modified or graded premiums, where initial payments are lower and gradually increase. Participating policies may pay dividends to policy owners, while non-participating policies do not. Whole life insurance is often used for long-term financial protection, estate planning, and accumulating cash value. What is a MEC? A MEC, or Modified Endowment Contract, is simply a life insurance policy that becomes overfunded. This happens when the owner pays too much premium too quickly, beyond what the IRS allows for a traditional life insurance policy. The key rule you must know for the exam is the 7-pay test. If the total premiums paid during the first 7 years exceed the IRS limit, the policy automatically becomes a MEC, and it stays a MEC permanently, even if you fix the funding later. Once a policy becomes a MEC, the tax treatment changes. Withdrawals and loans are taxed on a LIFO basis, meaning gains come out first and are fully taxable. If the owner is under age 59 and a half, there's also a 10% penalty, similar to early withdrawals from a retirement account. However, 2 things do not change. The death benefit is still tax-free, and the cash value continues to grow tax-deferred. Policies commonly become MECs when someone makes a single premium payment, makes a large early dump-in, or aggressively overfunds a UL, IUL, or whole life policy in the early years. Here's a simple example. Suppose you buy a life insurance policy, and the IRS limit says you can pay up to $10,000 per year for the first 7 years. If you pay $15,000 in year 2, you've exceeded the limit. The policy now becomes a MEC, and it will remain a MEC forever. Universal life insurance offers flexibility in both premiums and death benefits. Its cash value grows based on current interest rates, with a guaranteed minimum. Guaranteed Universal Life focuses on providing a reliable death benefit and minimal cash value, making it a popular choice for estate planning. Current Assumption Universal Life has cash value that changes according to prevailing interest rates, which can vary over time. Indexed Universal Life links cash value growth to a market index, like the S&P 500, with a floor to protect from losses and a cap to limit gains. Universal Life is ideal for people who want flexible coverage and adjustable premiums while still maintaining some guaranteed protection. Life insurance uses family and estate planning. 1. Family and child protection. Life insurance can be used to insure parents or children, providing long-term financial protection for the family. Common riders include: waiver of premium, keeps coverage active if the insured becomes disabled. Accelerated benefits, allows access to death benefit in case of terminal illness. 2. Estate planning. Life insurance is popular among high-net-worth individuals for estate planning. Often placed in irrevocable life insurance trusts, ILITs, to help minimize estate taxes. Flexible policy structures work well for long-term trusts. 3. Tax treatment. Cash value grows tax-deferred. Withdrawals are taxed only if they exceed the cost basis. Policy loans are generally tax-free. Death benefits are income tax-free. Summary: life insurance serves dual purposes, protecting family today and planning estates for tomorrow, while offering favorable tax treatment. Variable Universal Life combines the flexibility of universal life with investment options. Policyholders can allocate cash value to separate accounts, similar to mutual funds, which means returns are linked to market performance. Standard Variable Universal Life allows the cash value to fluctuate fully with the market, offering the potential for high growth but also higher risk. Some policies provide a no-lapse guarantee, ensuring the death benefit remains in place even if investments perform poorly, provided minimum premiums are paid. Variable Survivorship Universal Life covers two people and pays after the second death, often used for estate planning. This type of insurance suits clients seeking long-term growth potential and willing to accept market risk. DUL is a flexible life insurance policy that combines permanent coverage with investment options. Family and child uses. Popular with high-income families for long-term, tax-advantaged growth. Can support legacy planning and future financial security. Estate and inheritance uses. Often paired with ILITs to help reduce estate taxes. Useful for generational wealth transfer. Tax treatment. Investment growth is tax-deferred. Policy loans are generally tax-free. Withdrawals above the basis are taxed. Death benefit remains income tax-free. Important note: DUL is a security product, so it requires SEC disclosures and may involve investment risk. In summary, term life is the most affordable and provides temporary protection. Whole life is more expensive but guarantees lifelong coverage and cash value accumulation. Universal life allows flexible premiums and death benefits, with cash value growth tied to interest rates. Variable Universal Life offers both flexibility and market-linked cash value growth but requires the policyholder to accept investment risk. Choosing the right type depends on the client's financial goals, risk tolerance, and coverage needs. Understanding these differences is essential for explaining options clearly and helping clients make informed decisions.